Hello, this is Dave Maddock with Maddock and Associates, here to with a presentation about the Transitional Reinsurance Fee. So during this presentation, we're going to talk about what the Transitional Reinsurance Fee is, who needs to pay the fee, how to determine the total fee, and how to pay the fee. So Maddock and Associates, we're benefits brokers, been around for 45 years. Our goal is to really help employers offer great benefits and make it simple to do so while staying compliant. More information about our company is at maddockinsurance.com. Disclaimer, Maddock and Associates, we're not a tax accountant. The presentation is for informational purposes only and is not considered tax advice. Each company has different facts and circumstances which may not be addressed in this presentation. Make sure to consult with your tax accountant before filing and paying these fees. This presentation uses examples of the forms and methods that were given by the IRS for 2015 plan years. We're anticipating that the forms and filing methods will remain the same for 2016. However, the government does have the right to change the forms and processes each year. So what is the transitional reinsurance fee? The transitional reinsurance fee is a temporary fee that's assessed on all group medical insurance plans for 2014, 2015, and 2016. The purpose of this fee was to help compensate insurance companies in the insurance exchanges for heavy losses expected during the first few years while new people came into the individual insurance market that may have been forced out of the market prior. So with healthcare reform, they said in the individual market, the new law says that the insurance companies are not allowed to deny people for pre-existing conditions. So when that went away, there was, the insurance companies were concerned that they would all of a sudden get a lot of pent-up demand, people that had been excluded before coming onto the insurance plans and using a lot of services. And as history has shown us, that is definitely what has happened. The insurance companies are losing a lot of money in the individual insurance exchange. This fee is in place to help them with that, but as we noticed, when it came time to pay it, they paid out a lot less than what the insurance companies expected. Regardless of that fact, the fee is still due, and they have not, as of today, this is August 2016, changed what the fees are or the duration. So for 2016, the fee is now $27 per enrollee per year, and it's still supposed to go away after this year. So in 2017, unless they change something, this video and this information will not be important. So, but for 2016, it's still a requirement. So, who needs to pay the reinsurance fee? Basically, all group plans need to pay the reinsurance fee, but for fully insured plans, the insurance company completely handles that, and the employer is not involved at all. So, the fee is kind of built into the premium, but there's nothing the employer needs to do to pay it. The insurance companies just handle that. For self-insured ERISA plans, the employer does need to pay the fee or make arrangements for a third-party administrator to pay the fee. So self-insured plans are also called level-funded plans. These are going to be plans where generally you have to fill out a health questionnaire to get approved for them. You have access to claims data. And then generally on these plans, there's opportunity for a credit or refund if your claims beat a claims target. So the most popular plans in Washington right now are Cigna, All Savers, John Alden, which is also National General, and Starmark. There's also a lot of third-party administrators we deal with as well. So if you have any of these coverage with these carriers, you will most likely need to pay this fee. And as of today, All Savers, they will pay this fee for you. They send emails to the administrators, which you should have received already, which if you go online and give them permission, they will handle the reporting for you and simply bill you just for the cost of the fee. National General or John Alden, they sent out an email to everybody saying that they will handle the payment of the fee. They do charge for that. I believe it's $275 to do that. That's like their admin charge, and then they'll also bill you for the actual fee. Cigna and Starmark, they will give you reporting, but they'll request that you do but you're going to need to follow these instructions to do the reporting yourself. for, you know, so for if you're in All Savers, I definitely recommend just having them take care of that for you. Just go online to the email and sign off to have them do it. For National General John Alden Assurant, you might want to, I recommend watching this video and then deciding whether or not you want to pay them to do this or not. And then Star Mark or Cigna, definitely want to follow this video and then give us a call. We're here to help you with to help you do this. It's not complicated, but if someone else will do it for you, you might as well take advantage of that, right? So the presentation is intended for employers who have self-funded plans, and we'll explain how to calculate and pay the fee. So the due dates, these are the due dates that apply for 2016. So for filing, you need to file no later than November 15th of 2016. So that means going on and scheduling payment on pay.gov. And then you need to pay the fee no later than January 17th of 2017. There is a way to split out the fee. You can pay some in January 2017 and pay some later. We recommend just paying the whole thing right up front. There is a nice thing if groups that are self-funded and become self-funded on or after October 1st of the reporting year, then you do not have to worry about paying this fee. So any group that just signs up for a self-funded plan October 1 of 2016 or later, they're not going to have to pay the fee. Anybody that started a plan prior to that will have to pay the fee. So part of the complicated part about paying the fee is determining how many enrollees you have. So the reinsurance fee is based on the number of enrollees, not just employees, but dependents too. And they look at 9 months, the first 9 months of the calendar year. So the simplest way to count member count is called the snapshot method. So the way to use a snapshot method is you pick a date in the quarter that's the same for the first 3 quarters, i.e. the first day of the first month of the quarter. That date used for the second and third quarters must fall within the same week of the quarter as the corresponding date used for the first quarter. Then you calculate the member count for the first 3 quarters of the plan year using that same date. And then the reinsurance fee is based on the average member count throughout the first 9 months of the calendar year. So a tip, you can use your medical insurance billing to help determine the member count, but also don't forget COBRA enrollees. Generally, you can also ask the insurance company, third-party administrator, for a report to help you with this. A lot of them have these reports they can just kick out and get to you. If you need help with that, please let us know. We can get you in contact, or we can request a report for you. So here's an example of how to use the snapshot method for a company who has a plan that runs January through December 30th. Step 1 is to calculate the member count for the first 3 quarters. So what this person's going to do, they're going to use you know, the 5th of the month on the first 3 quarters. So they used March 5th, June 5th, and September 5th. So you know, you have 80 plus 88 plus 92 divided by 3 quarters. That gives them an average enrollee count of 87.33. And that's what they're going to use to pay the fee. It's okay to have fractions, and you just want to round to the nearest 2 decimal points. If it's not easy for you to count the number of enrolled dependents on your plan via the insurance reports or billing statement, the government does allow you to use a snapshot factor method. So you know, generally we can get you reports that'll just show you the member count, but if you're strictly going off your bill, a lot of times it won't show you how many dependents an employee has. So there'll be like an employee and spouse or employee spouse children, but it doesn't quickly list the number of children. So if that's an issue, you can use a snapshot factor method. So the way you do that is you use the same counting method. So you count for the first 3 quarters like we showed before, but you'll use you know, count each employee, like single employee, some people enrolled as self-only, as 1, and then anybody enrolled as something besides self-only, you count them as 2.35. So obviously that's going to overestimate anyone that's just employee and 1 child, or employee plus a spouse, but then, you know, full families, it kind of brings it down. So so anyway, that's a quick way to do the account. You know, if you don't know the how many dependents each person has. You also have the option of running it both ways and then taking the lower amount. So I know that All Savers, when they run the report, they show you they count it both ways, and they ask you to tell them which one to use. In that case, just take the lower one, because the government says you can use either method. So go with whichever one gives you the lower employee count. That will give you the lower cost. Usually, usually it's really close, the two. But if you have a plan with a lot of big families, then probably the snapshot factor method's going to save you money, because maybe your family's average more than 2.35. But if you have a family or a plan that has mostly single employees, you want to use the regular member count, because you don't want to, because or I guess what I'm saying is, a lot of single families or the people that have dependents just have like one spouse or one child, then you're going to be better off using just the regular snapshot method. So here's an example that I pulled off the government website of a large company, how they use 3 different quarters, and they're using the snapshot factor method. So as you see here in the total number of self-only, so those are the people that enrolled as single, so 1,000 on the first quarter. And then they look at the people that enrolled as something other than self, and they multiply that by 2.35, so to get the total. And then they add it up, divide it by 3. So some people will have switched to self-funding mid-year. So maybe you started a self-funded plan March 1st. So prior to that, you were on a fully funded plan. Or in this example, I have somebody that moved from fully insured to self-funded August 1st. In that case, you're not really having to pay, you're not going to have to pay the fee for the entire year, because the fully insured plan is going to pick it up for the first part of the year. So you just have to pay a prorated fee for the number of months that you're fully insured. So keep in mind, if you switched on October 1 or later, then you don't have to pay the fee at all. But if you switched from fully insured to self-insured before October 1, then you'll pay a prorated amount. So what you do is you'll add up the enrollee count for each month you were self-insured from January 1 through September 30th, and you divide by 9. So an example of an employee that went self-funded August 1st, they would just look at those 2 months, 44 in August 1 and 46 in September 1, and then they'll divide it by 9, because you get to prorate it over the whole 9 months. So that this group is only going to have to pay for 10 enrolled lives instead of the actual average of 45 what they have, because they're not going to have to pay for the entire year. So once you have the enrollment, the number count figured out, then it's time to register and pay. So there's information you'll read about supporting documentation. In the first year in 2014, it was required that you did this kind of complicated Excel sheet to show how you calculated your employee count. In 2015, they got rid of that requirement for anyone that was filing on behalf of 3 or less companies. So that supporting documentation here in step 3 that they say to upload on pay.gov, that's not going to be required for most groups. Most groups, you're just going to be reporting on your own company, not 4 or more. I guess if you had a lot of related companies that were all rolled up under the same plan, then you might need to do the supporting documentation. Or actually, third-party administrators that are filing for a whole bunch of different companies, they have to do the supporting documentation. But most groups, you're just filing for your company, so they'll basically just, you'll tell the government how many members you had using your snapshot factor method, but you don't have to submit any supporting documentation for that. With that said, you always want to keep the supporting documentation in case you're ever audited. So if the government ever questions, hey, why did you pay for 40 employees, maybe they cross-reference with your W-2s, and let's say you have a ton of part-time people that are ineligible, and you've got 100 W-2s, but you only paid on 42 employees. You'd be able to pull out your records, your reporting to show, oh no, I was right. We only had 42 members on the plan and so forth. So definitely keep the documentation that supports your employee count, but most of you will not need to submit that. So as mentioned before, the reporting's due November 15th, and basically to go to pay.gov and pay, you'll just need your company information and a bank account. So I'll do a quick demo of how this works, and this is as of August 18th. I'm doing this video. So what you do is you just open up a web browser and you go to pay.gov. And once you get there, the easiest way to find where you need to go is to actually just go to the search box here and type in reinsurance. It's going to get you right to where you need to go. And right now, as of August 18th, they do not have the 2016 form up and ready, so you can't file for 2016 right now. But once that is available, you'll be able to just click on the link below it and then continue, and you'll set up an account. Essentially, you'll put in your employee account, your company information, who you are and everything, and then you'll need to put in your bank account ACH because they want to do a bank draft withdrawal to pay for this. So you can actually click here to preview sort of what information they're going to request from you. It's really pretty basic, just your company information, who the contact is. Contributing entity is the company that sponsors a plan, so that's the same as the company that's paying. And then what we just it's usually going to be a new filing, and we really recommend just doing the combined collection. As I mentioned, if you wanted to, you could split it up and pay part of it in 2015 on January 15th. Keep in mind, when this is updated, that will take 2017, and the second part, November 15th of 2017. But ideally, you remember to do that. So most people just pay the whole thing at once. And then when you go on through the website, it will ask you through these different questions, and you'll just answer them, and then you have to sign off that you acknowledge it, and you just sign digitally online. So pretty basic process. Once again, you can give us a call with questions. We also recommend before you submit, you run this by your accountant just to verify. Keep your accountant in the loop what you're doing here. So really that's it. Go to pay.gov. The tricky part really is just getting your employee count figured out. Most of the third-party administrators, the insurance companies, will give that information to you, and then you just go to pay.gov. Go in there and set it up to pay, and give them your banking account information. So as I mentioned, you're going to need to wait. You can't do it right now as of August 18th. Generally, they'll get that information up in sometime in September, so you start paying the fee. But it's not due until November 15th, so you could even wait until October or November 14th if you want to. Any questions, give us a call, 800-875-4490. Hope this information was useful.